1.2 part 2 is actually from the new specification. We already did this in detail in lecture number 12, which I can show you right now as well. If you remember, we did direct, indirect, fixed, variable cost, everything. So I'll just refresh it quickly because this is the part which is for the new specification too, and it is going to be easy to understand. And then we have to move towards the main lecture.
Okay, ma'am.
All right. Use costing techniques for pricing purposes. The only difference is here we are going to use the command verb use. And in the old specification, we did the strengths and weaknesses separately for in every cost. Here we're not going to do that. Direct cost. These are the expenses directly attributable to producing a product or providing a service. For example, raw materials, direct labor, and manufacturing supplies. In a car manufacturing company, the cost of the steel used to build the car would be a direct cost. That is all the costs which are directly related or associated with in the making of or the production of the product is known as direct cost. All the costs which are associated in making the product which are directly related to making the product. They are all known as direct costs, like raw material, the primary initiate, each and everything inculcating in making or manufacturing the product. Whereas indirect cost, these are not directly tied to a specific product or service, but are necessary for overall operation. That is rent, maybe rent, the electricity bills, then the maintenance bill, each and everything is going to be under the indirect cost. They are helping in making the product, but they're not directly related to in the production of the product. For example, I'm making a perfume, I need initiative for the raw material. So definitely whatever the raw material is used to make the scent, that is direct cost. But the things which are being utilized in the production or during the production, that is indirect cost. Okay. Then we have fixed cost, which is unchangeable. It is fixed no matter what. For example, the salary of the factory supervisor, whether the production is going on, whether the sales are booming up, or you are having break-even analysis going on, you have to pay the factory supervisor. Then the variable costs. These costs are changing all the time. They are not fixed. Like, for example, if the inflation hikes up, due to some reasons or factors, economic factors, obviously, then definitely the cost of the variables are going to increase. For example, I was making a cake. The price was $10 each, a pack of cake. But now, due to the inflation, this is the hidden factor here, my price of the cake is going to be $13. That's what the variable cost. It can change. Calculating the unit cost, I'll the examples this time to make it more easy for you people. The unit cost is the total production cost divided by the number of units produced. Whatever the batch of the units are going to be produced, they are going to be known as the unit cost, the number of products produced. It includes both direct and indirect costs. To determine the price of a product, business often begin by calculating the unit cost. That is, when you have to quote a price of a product of an XYZ company, then definitely you need to calculate it. And by how we can do that? Simply by adding direct cost, indirect cost, which is going to be divided by the number of units produced, and we will be having the total unit cost. This is the example for you people. Let's say a company produces 1,000 units of the product with the total cost of $50,000. How are we going to do this? First, we will be dividing it by like it is given to us, the total direct cost is 30,000. That is more than the indirect cost. And indirect is 20,000. And in this, indirect cost is overhead and utilities. That is the expenses. How we are going to calculate the unit cost, that is the formula, which we will be doing in task 3 and 4 as well. Total cost, that is $50,000, and divided by the number of units. Simple. And we are going to get the price of product per unit. Clear?
Yes, ma'am, clear.
Yeah. These are honestly very simple, even in your task 2. You're only going to add the values and do the division and subtraction plus addition. That's it. Then dealing with the overheads in manufacturing and service industry, whenever we are talking about the overheads, we have to talk about the costing as well. That is full absorption, and the other one is EBC. So the overheads are indirect costs that cannot be directly traced to a specific product, business, use different costing methods to allocate or overhead costs to products or services. So overheads are actually the indirect costs, the expenses, and they are not directly related in making of the product. They are always indirectly acting. First one is the method of full absorption costing. This involves allocating all the fixed and variable manufacturing overhead costs to each.
Ma'am, sorry to interrupt you once again. Ma'am, in this point, as
Yep.
mentioned here, that these overheads are not direct costs. Why is it like indirect cost, ma'am?
Because it's
Like
an
why?
expense. It is not
Okay.
it is not directly related in making of the product. You always need raw materials rather than the daily expenses. Transportation costs, giving the cost to the suppliers, these are not related in making the product. It is going on the daily basis. Okay?
Yes, ma'am, clear.
Okay. All right. It ensures that each product is priced to cover all the costs, not just the direct costs. So, what the full absorption is teaching us? It is teaching us it is the amalgamation of both the cost, the fixed and variable. That is, direct and indirect both are going to be included whenever this costing method is being utilized by the companies because it depends on the companies which method they want to use. For example, a company producing furniture, it could be any bed, a chair, or something like that would allocate the cost such as factory rent. Now, rent is fixed, so it's a fixed cost. Utility bills, it changes with the passage of time. So we are going to consider it as a indirect cost or the variable cost and depreciation. Depreciation is the life of the assets which are being utilized in making the product. For example, machinery, computers, the one which have value to it. So everything is actually a depreciation in this specific part. Across all the products manufactured in a specific period, time period is always important in accountings and the business as well because it can count 6 months, 1 year, 2 weeks, 5 weeks, and so on. Then we have activity-based costing, that is the ABC. It allocates overhead costs, that is all the expenses which are based on the activities that drive the cost, the costs which are being utilized in the production of the product. Whatever the costs are, they are going to be under the heading of expenses. Just like we calculate in the income statement, we have a separate heading expenses. So whatever the expenses are going on in the organization within a span of 1 year or 6 months, we have to calculate it. It is more precise than full absorption costing and is more commonly used in service industries. ABC is widely used by every organization rather than going for the absorption costing because they have the amalgamation of both the direct and indirect and it gets busy sometimes. For example, if a consulting firm, that is the auditor's firms, use 3 hours of meeting time, the cost of meeting space and utilities can be traced more accurately to each client project based on how much time is spent. Like whenever we are applying for the universities, you're not applying on your own self, you are going to the agents and the consultancy firms. What happen is they are taking your time and giving you individual time as well. Whatever the product, the water or the tea they are serving you at that time, everything can be calculated and the time spent with each and every customer too. Then pricing strategies. Again, we have different strategies when we are quoting the prices of the product. The first one is cost plus pricing. In this method, the business calculate the cost of producing a product and add a fixed profit margin on the top. That is the markup profit is always added in the product. For example, if the price was $5 and I want to earn a more price over it, that is the profit actual. So I can add more amount to it, but it should be acceptable by the consumers as well. Because you already know that the producers, most of the time, for the products which are elastic, they are always price takers. They cannot make price by themselves. For example, because the competition is there in the market. If a unit cost of $50 and the business wants a 20% profit margin, the selling price would be. Now, this is the question that if the task requires you to ask that calculate the selling price for an XYZ product or whatever the scenario is, this is how you're going to do that. First of all, selling price equals to unit cost plus unit cost multiplied by profit margin. This is the formula for it. And it's because an assumption. So let's start with it. $50 is the cost of unit and How we're going to calculate it further? 50 multiplied by 0.20 equals to $60 because they want a markup of 20%. That is why the margin basically. Marginal cost pricing. In this, the price is set based on the marginal cost of producing an additional unit. That is, we are already making 50 bucks of units and 100 units in one batch. Accidentally, we are producing one more unit. So, this method is useful when a company needs to temporarily increase market share or deal with the excess capacity. When they're having a lot of resource at the back and they want to utilize it by making it more products rather than wasting it or dumping it. This is the reason why we get B pair dresses as well, the original dresses, and less price too, because they want to get rid of the stock. For example, if a factory's fixed costs are covered and producing one more unit cost only $10, that is the variable cost. Fixed cost cannot be changed, variable is changing. The company may decide to sell that extra unit of $12 just above the marginal cost to increase the short term sales. Although the price was $12, they were having a lot of excess at the back. That is the reason they made the price at $10 and they were selling their items. Just the way we get advantage in these sales. The original price is 8,000, for example, of a product or of a shirt only, Eastern shirt. On the sale, there is going on 50%. We're getting it for 4,000. The company is not getting loss. They are in the profit, like at the margin price. But when they were selling it 8K, they were actually having abnormal profits. Now they are fine as well at selling at the sale price too because they want to get rid of the stock. Then the taker price taker concept, the business operating in the competitive markets. Competitive market means you are having an edge and there's a competition for that as well. Once you introduce something unique, you already know that people start copying it, no matter what. They're going to come up with something new. The Kokomo, the Bisconi Kokomo, it's a widely snack utilized by the children. I was at the mart and I saw another company, Choco Chip. They were like selling it as a local brand and with a bear shape, but the quality was more amazing than the original one. So there are way too competition in the market. So you need to be very clear that how you're actually making the profit margin, and how you're going
Ma'am,
to price. Yes.
yes, ma'am. Even I also, is it also the same? Even some people copy one different product. Taste is different, but the brands also they copy.
Yeah. So there's
Suppose
the
there comes of like, is it like part of this as well? The one just making a
yes,
price
it is.
taker to price.
Yeah, it is. So you cannot charge abnormal price. You can only charge the abnormal price until and unless you are the one and only producing the XYZ product in the market.
Because, ma'am, for example,
Uh,
Cadbury chocolates, if you talk about, it tastes another country different, like quite different taste.
yes, that's true.
Mm.
Because the market of production, the warehouse and the manufacturing departments are different. Honestly, the one which are here in Pakistan, the local ones, they are literally, um, I just cannot eat them. But the branded one, the imported Cadbury dairy milk, it is amazing. You can get the varieties in it, the dark chocolate version too, the coin version too. There are so many things outside the country, but not in here, Pakistan. If we get it with the full price, the imported one, they're quite costly because we have custom duties on it. Okay. Break-even analysis, you already know this concept. Whenever we are not going to make profit nor loss, everybody is going to be perfectly fine doing on this. It is the equilibrium point. Total fixed cost, variable cost, everything is going to be under the break-even point. It is used to determine the point at which the total cost equals the total revenue. Cost includes fixed variable that comes up with the total cost. And we have to equal it to the revenue, generating the sales revenue. It helps business understand the minimum sales volume required to avoid losses. That is, you are going to earn the profit, you are going to be happy at a saturation period, but you're not going to entertain with the loss. That is the main point of any business which are running. Break-even point equals to fixed cost divided by the under the bracket selling price per unit less variable cost per unit. This is the formula when you're going to calculate in the task as well. First, you have to calculate the fixed cost, or it may be given, must be given. And we will be dividing the selling price per unit minus variable cost per unit. For example, if a company has fixed cost of $10,000, a selling price of $50, and variable cost of $30 per unit, the break-even point would be definitely fixed cost 10,000 divided by 50 minus 30. So 500 units is going to be what? Is going to be the units which need all the costs to be covered at the break-even analysis. Okay, then marginal costing. It focuses on the variable cost of production, ignoring the fixed cost in the short term. It is only utilized in the short-term period. Marginal costing is not used for the long-term period because we are considering the factor of variable cost in it. Fixed costs are fixed, they are not like they're unchangeable, and they are more preferred in the longer run. This method is especially useful when the business needs to make the pricing decision based on changes in the production level. For example, you are having a lot of bulk of stock at the warehouse, you're going to go ahead with the sales. So you're getting rid of the stock as well, plus you're having the break-even profit too. For instance, during a period of excess capacity, a hotel may decide to rent rooms at a price lower than full cost but higher than the marginal cost to generate short-term cash flow. In a shorter period of time, we're going to get the profit, but it is not going to retain for a longer period of time. It's not possible. Especially you see when in northern areas, in Pakistan specifically, the rooms, literally the pathetic rooms, their price hikes up. I'm not talking about the luxurious resorts and hotels at the moment. The normal hotels, which only provide you the normal amenities for the daily life, they also hike up with the prices just to gain the short-term profit. Using these various costing methods for pricing helps business determine the accurate and competitive prices while ensuring profitability. So we are taking the factor of profit while considering all the methods of cost, and it depends on the companies which method they want to utilize. Whether through full absorption costing, activity-based costing, or cost plus pricing, the selection of an appropriate pricing strategy depends on the business model, industry, and market condition, the point which I discussed earlier. By analyzing costs and applying the right technique, businesses can make informed decisions that support sustainable growth. Why we're talking all about these things? Because ultimately it helps in the growth of the business and taking the viable and strategic decisions on the daily basis. That is why these techniques are necessary. In the lecture 12, we did this part, these points on the command verb evaluate, but this is from the new specification. We have to do it in general. So that is why I did this again. Now, the last point, that is 3.3 assessment criteria. We will be doing that. And after this, our course is going to end. We're only going to have the assignment classes. Task 4, 5 for the old specification and 3, 4 for the new specification. With that, you would be seeing in the roadmap that there is 3D1 as well, 3 distinction 1. I did that in lecture 6. You can go to the portal, which is your LMS, and you can download those slides because 3D1 was the part of task 2, if you remember. That is why we did that earlier. Right now, we have to end it at 3.3. Clear?
Yes, ma'am.
Yes, ma'am.
Okay. Use capital investment appraisal techniques to evaluate a specific business decision. Here, every point is given at the indicative content under the heading of appraisal techniques or methods. We are going to discuss that. They are MPV, IRR, and ARR. And we need to evaluate them. That is the strengths and weaknesses, similarities and differences, and judgment at the end. Capital investment appraisal techniques. These are evaluating the potential long-term investments or the projects to determine if they are financially viable and will add value to the business. That is, the points which you're seeing in the bold, we will see whether the business has to use these or not, because it depends on the financial stability of the business, whether they can opt for these methods or not. So we will be discussing it one by one with the formula and examples too. ARR, accounting rate of return. What it means, the average annual profit from an investment as a percentage of the initial investment cost. This is the abbreviation or the full form of the formula too, if you can see it further. Average annual profit which you are earning on the investment, which could be XYZ or any investment, and what you did. Maybe You did the investment at 50,000 in the project, but now because of the profit, you have earned 1 lakh. So when we have to take the percentage out of it, we always multiply it by 100. It evaluates the profitability of the investment but doesn't account for the time value of money. That is, we did the investment in 2010, for example, but now the value of the money has increased, is appreciated, and increasing day by day, is accelerating. So we cannot make that factor into the time value for money. Formula is average annual profit divided by the initial investment multiplied by 100. For example, a company is considering purchasing a new machine for 1 lakh dollars, which is expected to generate $25,000 in profits annually for the next 5 years. Time is given to you and the amount is given to you. How we will be doing it? First of all, because here the time factor is given to us, that is, in accounts we note that is, we donate the number time with n or t. It depends on the formula too. So total profit over 5 years, how we're going to do that? Initial investment was 25,000. We're going to multiply that with 5. We are going to get the amount. And then for the average annual profit, ARR, we will be putting this in the formula. That is 125,000 divided by 5. We are going to get $25,000. So it was on initial investment $100,000. We are going to add that in the formula and multiply by 100. We will be getting the percentage answer. Clear? Exactly the same way we are going to do in the task as well. The reason to put this in the slide is just to give you more demo, although I'll be providing you more solutions in my Word document as well. But till now, uh, I hope this will be helpful to you people for both the specification people, old and new. Clear?
Yes, ma'am, it's clear.
Then if you remember the command verb evaluate, let's do that. The ARR for this investment is 25%, meaning the business expects to generate a 25% return on the investment entity. On the yearly basis, the investment which we are doing, we are generating 25% outcome out of it. Advantages are simple to calculate. Yes, it is. Gives a percentage return, making it easy to compare with other projects. That is, you can see and compare that with project B and project C as well, the financial performance. And then you can opt that on which project you want to do more investment. You can add more money into it. However, it ignores the time value of money because we are considering the factor of initial investment. That is why. It focuses only on profitability and does not account for cash flow timing. That is what amount of money is coming inside during the projects, because we have to compare with the other projects too. Payback period. The payback period calculates how long it will take to recover the initial investment from the cash flow generated by the project. It is a simple measure of risk. Payback means the amount which we have invested in the project, in how many times, month, week, years, we are going to recover it. Because it's always before, see, a give and take purpose. I have invested 1,000 in a business. I have to see at how many months I'm going to recover it. Maybe through profits or dividends. Formula is payback equals to initial investment divided by the cash flow, annual cash inflows. How much amount of money is coming into the business, into the project. For example, a company invests $200,000 in a new piece of equipment expected to generate 50 in annual cash inflows. I'm not going to do the complete wordings. Payback equals to simple. Initial investment was 200 divided by 50. What we're going to do? In how many years we're going to get the initial investment back? In 4 years. This means the business will recover its investment in 4 years. Very simple. Again, we will do this in the task as well. But it is going to be a bit different, but the formulas are all here with you people. Okay. It's easy to understand and calculate, useful for assessing the short-term risk. Sometimes what happens is when we are doing big investments, for example, we are new in the market and we have invested in an XYZ company without knowing the financial viability of it or its goodwill. Now we need to see whether we are going to be fruitful for it or not. Sometimes your investment gets into a loss too. So that is why it's a short-term risk. However, it ignores cash flows after the payback period. That is, once you recover the initial investment, you're not going to consider the amount which is coming into the project, into the business then. Because our main purpose in payback is recovering the initial investment or the cost. It ignores the time value of money, again, focuses only on the speed of recovery, not profitability, because the initial investment is our main goal, main motive. We're not going to see that what is the profit coming out of it. We have to only recover our investment only. And afterwards, you enjoy the profit, but it does not come under the payback period. Then we have NPV, net present value. NPV measure the present value of cash inflows generated by investment, discounted at a specific rate minus the initial investment. NPV accounts for the time value of money, making it more accurate than ARR and payback period. Organizations, they are always using NPV no matter what, because it is the best way to see what is the profit generated by the XYZ investment and at how much time we will be recovering the amount. Because it covers the cash flow, both inflows and outflows, so we have to see these as well, and the initial investment. Coming towards the formula, it is NPV equals to submission. This sign over here is submission. Okay? Like this. Okay? Into the bracket, we have cash flow divided by, again a small bracket, 1 plus R bracket times T. R over here is what? It's a discount rate. Whenever we are calculating NPV, we always get discount rates. Sometimes we have to calculate discount rates too. And we have to go for the exponential calculations. But this is not in your course. I think it's for higher levels. So we will do in that case in level 5, inshallah, or 7. Into T minus initial investment. T is time period. So R is discount rate, T is the time period. Now, if the NPV is positive, the value after calculating the NPV is positive, this means you are going to go for the investment in project A, B, C. NPV is not done for one project, it is done for multiple projects. 1, 2, 3, 4, 5, 6, and so on. A, B, C, D, E, F, G. If it's negative, then obviously you are not going to do the investment in that project. You are going to jump to another project. For example, suppose a company is evaluating an investment of this much in a project expected to generate cash inflows of 30,000 for 5 years. They told you your T as well, the discount rate for R is also given. Now what we're going to do is we're going to simply calculate it. So yearly cash flow is 30,000, R is 10, initial is 1 lakh. We're going to put everything in the formula. Maybe you are confused after watching this, what I did here, right? It is a simple
Yes, ma'am.
calculation version. Okay.
From the beginning of NPV version that time
All right.
itself getting.
See, this is the formula. See,
Yeah, formulas one says yes, ma'am.
what because of the time period in the question, it was 5 years, right? So I made myself more easier and viable that I'm going to calculate it one by one. For 1 year, that is 30,000 divided by 1 plus 10% discount rate into times 1. Then for year 2, then year for 3, 4, and 5. In this way, what happens is my calculations are going to be errorless. Everything is going to be perfectly into the figures. Because what happened is when we're going to do all the calculation times 5, the calculator is not going to give you the correct answer. That is what the problem. So we are going to do that step by step. This is the outcome of year 1. Then this is for year 2, 3, 4, 5. And we have to subtract it with the initial investment. So what do we get in the end? 13,722. And this means this project is actually adding the value to the profit. That is more money into the profit. That is the reason we are going to do the investment in this project. Clear?
No, ma'am.
Okay. Where's the problem? We can do that again.
Maybe the
What?
calculation part actually,
Okay.
like the
See,
second,
this,
yeah, like
okay. Simple. This is the formula. Cash flow divided by 1 plus R into times T. Just because in the question, in the example, they have given us 5 years. I did this formula for 5 times, but I only subtracted the initial investment only once. This is what I did. See, cash inflow 1 plus R into T.
ma'am doesn't have cash outflow, right? Because it's only an inflow.
Yeah, at the moment, inflow.
Okay.
It is given in the question. Everything is in the question.
Okay.
Cash flow, which is inflow at the moment, is 30,000. Point 10 is the discount rate. Whenever we do this in the calculation part, we always multiply it by 100 and we get 0.110. You can do that in the calculator right now as well. And this 1, 2, 3, this is the time factor, the year factor, which we calculated and is even given in the question too. Now, is it clear?
Yes, ma'am, I understand.
It's not difficult at all. What only what it's the problem? What's the problem is you need more time. Once you're going to do this with the help of task, and everything is going to be easy for you, inshallah. Because this is the first time you're getting familiar with these formulas. That is why. People from the background of accounts, they're going to be okay, but the others are going to get a problem. But I'll do that again with you people. Don't worry. Again, advantages, it's accounts for the time value of money. Now, if you see the others one were relating with the time value of money, but this does not. It provides a clear indication of whether investment will add value because it's very simple. It's telling you whether to opt for the project or not, or the investment. If not, then we can jump to the next project. It considers all cash flows over the project life, that is inflow and outflow. It depends on the question and the scenario and project itself, like in the example we did with the inflow. However, it requires an account or accurate discount rate. If I told you earlier that sometimes discount rate is not given. So what happened is we always calculated with the exponential rate, which is a bit difficult concept, but again, we need to do this. It has more complex to calculate than payback period or ARR, and that was true as well. You people made me revise it for the 2 times because it is technical, but it's not difficult. Once you get the grip on it, everything is easy. Then we have a IRR or internal rate of return. Internal rate of return is the discount rate that makes the NPV of an investment equal to zero. That is, this is a kind of investment. Whenever we use this in an organization, it accounts our investment to zero. We will see how. It represents the rate of return expected from the project. So whatever the rate of return, the rate on the investment which we added in the project, we are going to see that in terms of the projects. If the IRR is higher than the company's required rate of return, for example, my rate of return for the company is 5% and it came to 10%, for example, then we're going to see that this project is perfect. We are going to do the investment in it. So the internal rate of return should be always higher in the positive amount. For example, as you remember, this was the formula that it should always be zero. The investments equal to zero. So zero equals to submission cash flow divided by 1 plus IRR, whatever the amount will be, into times T minus initial investment. So these formulas are quite familiar for the NPV as well and the internal rate of return. So you need to be very careful. This is IRR and in NPV it is only R, discount rate. For example, assume a company is evaluating $100,000 investment with the cash inflow of 30,000 annually for 5 years. Time is given to us, cash inflow is told to us, and the initial investment too. Let's start with it. Just adding it by into the formula, everything, and doing the calculation because and one more thing, we're not going to do it for 5 years. It's just you need to add 5 into the T. We're not going to do it like NPV, 1, 2, 3, 4, 5 years or 4 years. We are only going to do this for total 5 years. So using the trial and error or the financial software, IRR is mostly accepted by the softwares. There's the certain financial softwares like SPSS, Excel. Then we have R tool as well. These are used in the accounts to calculate these calculations. People don't calculate them. The IRR for this example is calculated to be 14.87%. So this is the answer when we are going to put the value in the formula. And what it means that this investment is going to be perfectly fine for us. So we are going to opt for the project. Advantages again account for the time value of money. It provides a percentage return, making it easy to compare with other investment. We are going to do the NPV for 1 year, 2 year, 3 year, and so on. The IRR is going to give you amalgamative amount of percentage, and it gets easy. The higher the percentage rate, it means it would be perfectly fine to invest in the project rather than going with the negative or reduction amount. However, it is difficult to calculate manually, as I told you earlier, may provide misleading results for non-conventional cash flows, for example, multiple negative cash flows. Maybe you are not, there is a problem in the accounts and we are having properly negative in cash flows. So what will happen? It is not going to give us proper amount. It assumes reinvestment of the IRR rate, which may not always be realistic. Again, it is always a time to calculate from the software. That is why it can give us unrealistic values too. Okay, this is a real life example, and we are done with the lecture. So from slide 25 and 26, we can do this in the lecture class as well. I hope the lecture is clear to you because it's just an amalgamation of the complete ARR, payback period, NPV, and IRR, which we did today. It is just for your convenience. Clear?
Yes, ma'am.
Yes, ma'am.
Okay, don't get sad, people. Don't worry.